Financial platforms are often discussed as if all users evaluate them through the same lens. In reality, entrepreneurs and retail traders assess platforms using fundamentally different criteria. This difference has become especially visible in 2026 as markets, infrastructure, and operational complexity continue to increase. While retail traders often focus on features and short-term usability, entrepreneurs approach financial platforms as operational systems. Retail traders typically interact with platforms as end users. Entrepreneurs, on the other hand, interact with them as system builders. This distinction shapes everything from onboarding decisions to long-term platform trust. Retail traders often ask, is the interface easy to use? Are the fees competitive? Does it support my strategy? Entrepreneurs are more likely to ask, how predictable is execution under stress? How does this platform behave operationally over time? Can it scale with capital and complexity? Does it reduce or introduce infrastructure risk? The platform is not just a tool, it becomes part of the business environment. One of the clearest differences lies in how risk is perceived. Retail traders often focus on market risk, price movement, volatility, and timing. Entrepreneurs place greater emphasis on infrastructure risk, including execution reliability, platform dependency, operational continuity, procedural clarity. For entrepreneurs, unexpected technical friction is not a nuisance. It is a business liability. This is why execution stability and system predictability often outweigh feature richness in platform evaluation. Retail traders frequently operate on shorter decision cycles, individual trades, daily or weekly performance, immediate feedback. Entrepreneurs evaluate platforms over longer horizons, months or years across varying market conditions through operational consistency rather than isolated outcomes. A platform that performs well in ideal conditions but behaves inconsistently under stress fails the entrepreneur's evaluation, even if short-term results appear attractive. Another major difference is the role of performance claims. Retail traders may still be influenced by advertised spreads, promotional features, success stories. Entrepreneurs tend to discount narratives and focus instead on process transparency, operational logic, clearly defined system limits. They understand that performance is an output of structure, not a promise that can be evaluated in advance. Entrepreneurs rarely view capital as a single pool deployed impulsively. Instead, they segment capital across systems, limit exposure per platform, treat access and liquidity as controllable variables. This makes platform behavior under partial load, restricted exposure, or phase scaling especially important, something retail traders often only encounter later in their development. For entrepreneurs, choosing a financial platform resembles due diligence, not experimentation. They assess operational predictability, consistency of execution logic, clarity of procedures, alignment with risk frameworks. This mindset aligns naturally with structured environments that prioritize clarity and system behavior over aggressive positioning. The emphasis is not on results, but on how reliably the system supports decision-making. The growing gap between how entrepreneurs and retail traders evaluate platforms signals a broader market shift. Trading is becoming more system-oriented, infrastructure awareness is increasing, operational risk is being treated as strategic risk. As more traders transition into entrepreneurial thinking, platform expectations continue to rise. Entrepreneurs do not look for platforms that promise opportunity. They look for platforms that support control, predictability, and scalability. This difference explains why the same platform can be evaluated very differently depending on who is using it. In 2026, platform selection is no longer about preference, it is about fit within a broader operational system.